Good afternoon and welcome. My name is Bill Woodruff. Today I'm going to share some introductory thoughts on a newer and what I think is an up and coming area of the investment industry, which is direct indexing. Before I get too far in, I'm going to say a few words for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainty, some of which are significant in scope and by their very nature beyond the control of Wealth Factor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. For those of you who don't know me or are less familiar, I've been involved in investing for over 20 years now. I have a diverse career in the industry. Started by being involved with actually a hedge fund, doing trading and building trading systems. Also spent time doing investment manager research and due diligence, not just at hedge funds, but also private equity, a little bit of private real estate, private debt. So very diverse experience set there. In 2011, I launched a mutual fund. In 2014, I sold that mutual fund business line to the public company Fortress Investment Group and spent some time with them. A lot of my background has been providing investment-related services or products to other investment professionals. A lot of what I've seen in the industry I've never felt very good about. I've seen layers of management, complexity, and layers of fees, most of which aren't benefiting clients. And that's what largely led me to the creation of and founding of Wealth Factor in 2017. Wealth Factor is a Lake Oswego-based investment advisor. We do customized, plan-oriented investment advice solutions for our clients. We manage custom portfolios that are primarily comprised of index-based exposures to stocks and or bonds. Accounts are held in our client's name and at independent third-party custodians, and we charge a 0.35% fee for the entirety of our services. Just as a brief introduction to how I view the world from an investment philosophy perspective, we operate under an approach that's called Risk Smart that has three component parts. The first is called Portfolio Smart, and this is really a reference to the efficiency of how you get to your exposures and the efficiency of the investment process and strategy, and it's largely about what you avoid as an investor. So I look at the attempts to pick and time securities, sectors, markets as largely inefficient. And I look at the same thing in regards to layers of management or complex investment structures and strategies. The next part is Fee Smart, and today's topic we'll talk a little bit about cost of getting to your exposures, but Wealth Factor is really centered around the idea that if you're providing an investment-related service and your fees are high, you're really forcing yourself into a position where your investment solution or your investment advice by its very nature needs to take more risk, which is really in nobody's best interest. And then the last component of being risk smart is being tax smart. Taxes are oftentimes an afterthought by the average advisor, but it's my opinion that taxes and tax management is actually one of the highest areas where an advisor can, on each individual client's custom solution, add the most value. What is direct indexing? Well, here's an example to kind of explain what the process or strategy of direct indexing is. Suppose you invest in an ETF or mutual fund that tracks the S&P 500 index. In this example or this case, your assets are commingled with the assets of others. The assets are managed by a management firm that sponsors that ETF and does the trading administration that's necessary. In contrast to that common structure, A direct indexing strategy bypasses the fund structure and using an account in a client's name purchases individual securities associated with an index on behalf of the end investor or that particular client. In this case, or this example, the direct index would hold all 500 stocks in the S&P 500. Theoretically, the returns from buying the individual stocks would be substantially similar to the returns produced by that similar fund that's mimicking that same index. Mutual funds and ETFs offer and have been innovations in their own right, easy access and affordable access for smaller investors to a broadly diverse portfolio. And we've seen in the ETF space, and to a lesser extent the mutual fund space, a race towards very, very low fees, if not zero management fees in some of the simplest index-based funds. In the last several years, direct indexing has become far more accessible. Direct indexing has been around for a long time, but up until really the last several years, it took a fairly substantial size portfolio, $5, $10, $20 million or more, for it to make sense relative to buying mutual funds or ETFs. Well, in the last several years, there have been a handful of elements that have made it possible for somebody like myself with a trading system, design, implementation background to create processes and systems to do that implementation. We've also seen, and I'm going a little bit out of order here, increases in speed and power of computing, as well as the reduction of the cost of getting to those things that make it easier to create and utilize these sorts of systems. And then also a big factor is the reduction of commission costs. We're seeing Robinhood's getting a ton of attention right now for zero commissions. But if you're paying attention, you're also seeing interesting articles that are highlighting their record income and profit. And so, as a student of the industry, would discourage anybody from using Robinhood for the following reason, and that's execution quality. Robinhood's not offering their services for free. They're making money in other ways. And in terms of implementing a direct indexing strategy and what's caused it to become more accessible is the accessibility of execution algorithms. And so a combination of overall trading costs coming down, and that doesn't just mean free commissions, because that Robinhood example gives a reason why you probably would prefer to pay some small commission per trade, but yet have high execution quality, which is now again accessible thanks to execution algorithms. So why might somebody be interested in direct indexing? Well, in some cases, it removes a layer of costs. I mean, theoretically, there are ETFs that have little to no cost. Most indices that I recommend to clients will have, even in large cap, large companies in the U.S., at least 15 basis points of fees. And so if I'm providing my service for 35 basis points, 15 basis points of that potentially is being avoided just by not outsourcing to an ETF, or I don't use mutual funds, but a fund, that 15 to, and on the small cap side, it can be 20 to 30 basis points. And so removing that layer of costs is a potential reason to direct index. The second is customization, and this can mean the motives for customization can be different for lots of people. And so one example is somebody might be, have a high degree of sensitivity to impact, and so you can, with direct indexing, you could filter out companies that might be less socially responsible. You have control of the overall factor dynamics of a portfolio, and so I might use a index that actually is not constructed based on the size of companies, or a market cap weighted index, which is the most common type of index-based fund, but use something that might select an index that might be building its portfolio based on different things, what the industry calls factors, which might be valuation, quality, size, et cetera. And then another potential application in regards to customization is as investors go from the accumulation phase to approaching retirement or starting in retirement, they're faced with some difficult challenges right now in regards to creating income in especially in safe ways. And so yields are at historic lows, which creates unique challenges in that regard. And so what one could potentially do, and it's something I've done with client portfolios, is take my index and filter out companies that don't pay dividends, which would increase the average yield or dividend yield of that index. And clearly, as you do customized variations of an index, the deviation or difference in your results or performance will be higher, based on my experience, that it has an equal probability of being positive versus negative. I think the key to what I would call evidence-based investing or passive or index-based investing is the consistency implementation of your approach, staying disciplined and saying, this is my investment plan, this is the way I'm building my portfolio, and I'm going to consistently apply that. I'm not going to try to time into being in dividend stocks now or not in dividend stocks at a particular time. It's really identifying what's the optimal, considering all elements, tax, ability to take risk, need for income, creating that optimal portfolio and staying disciplined in its implementation. The last and probably the biggest motivator when I make recommendations to my clients about potentially using direct indexing is the tax control. When you own an ETF or any kind of fund, you have really one tax decision. You sell it or you don't. Whereas if you take a direct indexing, if you choose to get that same or substantially similar exposure through direct indexing, you now have potentially hundreds of individual tax decisions, and those so creating an opportunity to be proactive in the management of your tax. And so if you have a year where you're maybe a higher income or you have a capital gain from something somewhere else, you can go actively harvest losses to reduce the tax liability in this year. And while taxes and tax code it feels like a moving target and subject to future increases, I generally look to try to push out paying tax as far as I can in most cases. Obviously, there are exceptions in each individual's tax situation, and planning is unique. It's also worth noting that through position level tax management, you can also defer gains as well. So avoiding taking a gain in even just the difference between selling in December versus selling in January might shift the tax liability a fair amount of time. So there are, like everything in investing and really in the world, important considerations and potential limitations to direct indexing. One, and I've felt this with clients, is you're increasing the number of holdings in a portfolio. And so, when I'm, one of the biggest jobs that I have with a client is helping them avoid making investment mistakes, which are oftentimes linked to behavioral biases that we have. And when there is more information, that isn't always good in terms of identifying something. For example, Goldman Sachs or Wells Fargo or whomever has certainly had a fair amount of negative media attention. An investor might see, I own that, and the process of owning it is just simply part of the process of owning a very diverse basket, and that might receive an undue amount of attention relative to what's important in a successful outcome, and attempting to create a successful outcome. Having a significant number of additional holdings in the portfolio can shift the focus away from what matters most in working with clients. I do create my own quarterly or potentially monthly in certain cases summary reporting, and will generally summarize each direct indexing based allocation up into a single line item for overall reporting purposes, just like you might see a single ETF or fund. You are going to see an increased trading cost. There's absolutely efficiencies of scale for large funds, ETFs. They pay on a per dollar basis per year far less than you will as a direct indexer, really no, regardless of the size of your portfolio. If you're saving 15 basis points versus owning the ETF, some part of that is going to go to trading costs. Generally, my passive approach to investing, there's some costs on the front end to establish the portfolio, and then annually most of the costs can be attributed to maintaining exposure to structurally to the index as well as the tax motivated selling. There's a bit of greater operational complexity, and this creates perhaps some slightly increased potential for errors. So worth noting that. And then lastly, and this is absolutely something that will shift as I'm providing advice to a client or prospective client, influences the decision or choice to use ETFs instead of direct indexing. And that's largely tax advantages aren't always useful because of retirement accounts. And so in retirement accounts, it's really largely dependent on potential cost savings and the motives for customizing. In summary, ETFs will remain an important tool, but offering direct indexing directly to our clients is one of the many competitive advantages we have versus the average advisor. I hope you found today's presentation useful and informative. If you'd like to learn more, please don't hesitate to reach out. I hope you have a great afternoon.